Good morning. The European opening bell rings today against a backdrop of mounting geopolitical anxiety and a structural shift in the energy narrative. We are seeing a continent under pressure. European indices are struggling to find a footing as the geopolitical friction between Washington and Tehran moves from rhetoric to a tangible market discount. The primary driver this morning is the direct fallout from Trump's war with Iran, narrative that has dominated the headlines in Time magazine and beyond. The European Union is uniquely vulnerable here. Unlike the United States, which has achieved a degree of energy independence through shale, Europe remains a captive customer of global energy volatility. Today, Ursula von der Leyen and Fatih Birol of the IEA are meeting to discuss one thing: how to prevent a total decoupling of energy prices from economic reality. We are looking at a scenario where Brent has topped $87 a barrel and WTI is surging over 6%. For a European manufacturing base already reeling from the structural shift away from cheap Russian gas, this second energy shock, driven by Middle Eastern instability, is potentially catastrophic. We are seeing the DAX and the CAC 40 open with significant caution. Investors are pricing in the Lagarde uncertainty. At her recent speech at Johns Hopkins, the ECB President transitioned her vocabulary from risk management to navigating uncertainty. This is a critical distinction for traders. Risk can be modeled, uncertainty cannot. The ECB is currently caught in a vice. On one hand, US inflation slowing to 2.4% suggests a global cooling that should allow for rate cuts. On the other hand, the Iran war scenario is an inflationary hand grenade. If energy prices continue this trajectory, the ECB's path to normalization is effectively blocked. Furthermore, we must look at the corporate credit spreads in Europe. As energy costs rise, the mortgage interest tax deduction and general consumer liquidity discussions we see in the US are mirrored here by fears of industrial insolvency. The cost of hedging is rising. The VIX, currently sitting at 24.38, up over 2.6%, is reflecting a global contagion of fear that started in the European energy pits this morning. Europe is the front line of this macro volatility. If von der Leyen cannot secure a coordinated response to these spiraling prices, the European recovery is not just delayed, it's derailed. Moving to the US, the picture is one of defensive positioning and a quiet exodus from high beta plays. Wall Street futures are currently deep in the red. The S&P 500 futures, S equals F, are trading at 6,808.00, down 0.56%. The Nasdaq 100 futures, NQ equals F, are feeling the brunt of the sell-off, down 0.75% at 24,918.50. This is a classic risk-off environment. When the VIX jumps nearly 3% to settle above 24, the market is telling you that the era of low volatility complacency is officially over. Why the sudden retreat? It is the intersection of two fears: geopolitical escalation and the Buffett warning. Warren Buffett's decision to sit on a staggering $187 billion in cash is the ghost haunting the trading floor. When the Oracle of Omaha signals that it is time to be fearful, the institutional desks listen. His warning suggests that equity valuations, even with the S&P at these historic levels, have disconnected from the underlying cash flow realities of a world at war. We are seeing a specific divergence in tech. Despite the broader Nasdaq weakness, Nvidia is showing resilience, up 0.68% at 183.34. The market is still betting on the AI secular trend as a hedge against labor inflation. However, Apple and Tesla are flatlining, barely holding on to 0.02% gains. The Trump-Iran factor is the wildcard here. A protracted conflict in the Middle East threatens the global supply chains that these tech giants rely upon. The futures market is also reacting to the slower US job growth forecasts. While the unemployment rate is expected to hold steady at 4.3%, the whisper numbers for the February payrolls are coming in light. This creates a bad news is actually bad news scenario. Usually, a cooling labor market would embolden the Fed to cut rates, but with oil at $84.91 and rising, the Fed doesn't have the luxury of cutting into an energy spike. Traders are realizing that we might be entering a stagflationary pocket, and the futures are pricing that reality in real time. In Asia, the narrative is slightly more nuanced, but no less tense. The KOSPI index in South Korea managed a marginal gain of 0.02%, closing at 5,584.87. However, the flat headline number masks a sudden shift in investor sentiment that we are tracking closely. South Korea is a proxy for global trade. When the KOSPI wobbles, it's usually a precursor to a shift in global manufacturing demand. Investors in Seoul are navigating a treacherous path. On one side, they are buoyed by the continued demand for high-end semiconductors, hence the relative strength compared to the US futures. On the other, the proximity to regional tensions and the reliance on imported energy makes the South Korean economy a canary in the coal mine for the Iran-driven oil shock. The KOSPI update suggests that while investors are holding their ground, they are rotating out of cyclicals and into more defensive, large-cap names. We are also seeing a ripple effect from the Japanese markets. The yen's volatility is impacting carry trades, and the uncertainty mentioned by Lagarde is echoing through the Asian sessions. The focus remains on whether the sudden shift in South Korean stocks is a localized rebalancing or the start of a broader Asian exodus. Watch the KOSPI 200 futures tonight. If they break below the 5,500 level, it will signal that Asian institutional money is moving to the sidelines, following the Buffett lead. The geopolitical tension between the US and Iran is particularly sensitive for Asia. The Strait of Hormuz is the jugular vein for Asian energy imports. Any disruption there doesn't just raise prices, it halts production. This is why we see such tight trading ranges in the KOSPI. It is the silence before the storm. Traders are waiting for the next headline from the White House or Tehran before committing to a direction. The bond market is currently the most intense theater of financial warfare. Bond traders are scouring jobs data with a level of desperation we haven't seen in recent quarters. The objective? To gauge the Fed's path amidst this sudden oil shock. Currently, the benchmark yields are reflecting a massive tug of war. On one hand, the slowing inflation to 2.4% in January should be a green light for a bond rally and lower yields. On the other, the energy spike is an inflationary tax that the market has to price in. This is why we are seeing a flattening of the yield curve. The market is increasingly skeptical that the Fed can engineer a soft landing if Brent crude stays above $87. Look at the top CD rates being reported, hitting 4.30%. This is a significant psychological threshold. When retail investors can lock in a guaranteed 4.30% in a CD, the risk premium for holding equities, especially with the VIX at 24, becomes much less attractive. This is the Buffett warning in action. Cash is no longer trash, it is a strategic weapon. The bond traders' scour is centered on the upcoming February jobs report. The forecast of 4.3% unemployment is the line in the sand. If unemployment ticks higher, it confirms the slowdown. If it stays steady while energy prices soar, it creates a nightmare scenario for bondholders, sticky inflation, combined with stagnant growth. We are seeing significant outflows from long-dated treasuries as investors fear the long-term inflationary impact of a Middle Eastern war. The bond market is telling us that the Fed pivot, everyone expected for 2026, is now under existential threat from the oil shock. We need to talk about the divergence in central bank rhetoric. Christine Lagarde's message at Johns Hopkins was a watershed moment. By moving from risk to uncertainty, she is effectively telling the markets to throw away their models. In the world of the ECB, uncertainty means a pause. It means that the path to interest rate cuts, which the European economy so desperately needs, is now clouded by the Iran war contingency. Across the Atlantic, the Fed is in an equally difficult position. US inflation slowed to 2.4%. Under normal circumstances, Jerome Powell would be preparing the markets for a series of dovish moves. But the oil rally has changed the math. Energy is the ultimate input cost. If it resumes its climb toward $90 or $100 a barrel, that 2.4% inflation print will be a distant memory by the time the next quarter's data arrives. The central banks are now data-dependent to a fault. But what happens when the data is contradictory? Slower job growth suggests a cooling economy, while rising energy suggests an overheating price index. This is the classic central banker's dilemma. The markets are also watching the rhetoric from von der Leyen. While not a central banker, her coordination with the IEA's Birol on energy prices is a form of shadow monetary policy. If they cannot cap energy costs through fiscal or diplomatic means, the central banks will be forced to keep rates higher for longer to combat the resulting inflation, even if it crushes the consumer. The credit union movement and the rise in mortgage-related searches, how much is the monthly payment on an $800,000 mortgage, show that the public is already feeling the pinch of these sustained high rates. The central banks are trapped between a geopolitical rock and a macroeconomic hard place. The energy sector is the epicenter of today's market action. Crude oil, CL equals F, is up a staggering 6.07%, trading at 84.91. Brent has already cleared the $87 mark. This is not just a brief dip being bought. This is a fundamental repricing of geopolitical risk. The Trump's war with Iran narrative has moved from the pages of Time magazine into the order books of every major energy desk in London and New York. The oil rally resumes headline is the most critical factor for the next 30 days. We are looking at a potential supply disruption in the Persian Gulf. If the Strait of Hormuz is even partially blocked, $84 oil will look cheap. Gold, GC equals F, meanwhile, is showing a strange divergence. Despite the chaos, it is down 0.68% at 5,102.30. However, do not be fooled. At 5,102, gold is at a historic, almost surreal valuation compared to years prior. The minor dip today is likely profit taking after a massive safe haven run. The light finance forecast for gold remains bullish for the next 30 days. In a world of uncertainty, as Lagarde puts it, gold is the only certain asset. The current price level of 5,102 suggests that the market is already pricing in a significant devaluation of fiat currencies or a systemic collapse of the traditional bond market order. We must also consider the energy crisis discussions between von der Leyen and Birol. They are looking at spiraling energy prices, not just as a market phenomenon, but as a threat to civil stability in Europe. The industrial heartland of Germany is at risk. If oil and gas prices stay at these levels, the sector focus will shift entirely from growth to survival. Energy is no longer a commodity. It is a geopolitical weapon, and currently, the West is on the defensive. In the equity sectors, the story is one of innovation versus litigation, and survival versus growth. Let's look at the VIPs of the day. Elon Musk is back in the crosshairs. Musk's freewheeling tweets land him in legal jeopardy again, according to Bloomberg. For Tesla investors, this is a recurring nightmare. While the stock is technically up 0.02% at 405.55, the legal overhang prevents it from participating in any AI-driven rally. Tesla is increasingly seen as a key man risk play rather than a pure auto or tech play. Nvidia, at 183.34, remains the gold standard of the AI sector. The 0.68% gain in a sea of red futures tells you everything you need to know. AI is the only sector where investors are willing to pay a premium despite the macro headwinds. The "Can AI do my taxes?" headline is more than just a consumer tip, it's a sign of the total integration of LLMs into the services economy. This productivity promise is what keeps NVIDIA and other chip makers afloat. However, the "one stock down 14% to buy on the dip" narrative is gaining steam in the value investing community. As the broader market retreats, institutional bottom fishers are looking for quality companies that have been unfairly punished by the oil shock. Then there is the housing sector. The questions around mortgage interest tax deduction and the cost of an $800,000 mortgage highlight a consumer base that is stretched to the limit. We are seeing a shift toward credit unions as consumers flee the traditional banking fees. If the housing market freezes due to these 4.30% CD rates and high mortgage payments, the wealth effect that has supported US consumption will evaporate. Watch the retail and homebuilder sectors closely. They are the most vulnerable to this higher for longer, energy-driven reality. In the FX markets, the US dollar remains the cleanest shirt in the dirty laundry. As the VIX rises to 24.38 and geopolitical tensions escalate, the flight to quality is benefiting the greenback. The euro is under significant pressure. The Morningstar analysis of what the Iran war means for European inflation suggests a period of stagflationary euro weakness. The ECB is in a checkmate position. If they raise rates to fight the energy-induced inflation, they crush the already weak growth. If they cut rates to support growth, they let inflation run wild and the euro collapse. The market knows this. Consequently, we are seeing the euro trade with a heavy bias. In Asia, the sudden shift in South Korean stocks is also a currency story. The one is sensitive to both trade flows and energy prices. A rising oil bill for a country with no domestic energy resources is a recipe for currency depreciation. We are also watching the commodity currencies, the loonie, the Aussie, and the NOK. Usually, they would rally on the back of $84 oil. However, the uncertainty of a full-scale war is tempering that rally. Traders are worried that the oil shock will lead to a global recession so severe that it will eventually destroy demand, rendering the current price spike temporary. In the short term, however, the dollar is king. The Buffett warning of holding $187 billion in cash is essentially a massive long dollar position. When the world's most famous investor chooses cash over everything else, the FX markets follow that lead. The crypto space is providing some of the most dramatic data points today. Bitcoin, BTC/USD, is trading at 70,388.70, down a marginal 0.57%. However, the context is everything. We are nearing the $73,000 level again. Michael Saylor of MicroStrategy is doubling down on his thesis that there isn't enough Bitcoin for everyone. Saylor's math actually checks out when you look at the institutional adoption curves. MicroStrategy and Robinhood are surging as Bitcoin nears these local highs. For Saylor, Bitcoin isn't a risk asset, it's digital property. In a world where von der Leyen is fighting energy spirals and Trump is potentially at war with Iran, the censorship-resistant and finite nature of Bitcoin becomes a powerful narrative. However, look at MSTR's price today, 139.81, down 0.06%. This suggests a slight exhaustion in the crypto proxy trades. The Saylor math might be correct in the long term, but in the short term, Bitcoin is still behaving like a high beta tech asset. When the Nasdaq, NQ equals F, is down 0.75%, Bitcoin struggles to break out. The crypto markets are currently a battleground between the digital gold believers and the macro risk sellers. If Bitcoin can hold the $70,000 level while the VIX is at 24 and oil is at $84, it will be a massive structural win for the bulls. It would prove that BTC has decoupled from the risk-on bucket and moved into the alternative store of value bucket alongside gold, which is sitting at 5102. Watch the $73,000 resistance. If that breaks, the Saylor math becomes the only math the market cares about. Looking ahead, the calendar is packed with high-impact events that will determine if this oil shock becomes a permanent fixture of 2026. First, we have the February jobs report. The consensus is a steady 4.3% unemployment rate. If this number comes in higher, say 4.5%, the market will pivot from inflation fear to recession fear. This would be a risk-off accelerant. Second, the market is awaiting further clarity on the Trump-Iran situation. Any official statement from the White House regarding the Strait of Hormuz will move oil by $5 in either direction instantly. This is the definition of a binary event calendar. Third, in Europe, we have the follow-up meetings between von der Leyen and Birol. Any announcement of coordinated strategic reserve releases or energy price caps will be a major catalyst for the DAX and the euro. Fourth, watch the VIP movements. Michael Saylor's next MicroStrategy purchase announcement and Warren Buffett's quarterly filings are the shadow calendar items that institutional traders are watching. Finally, the top CD rates and mortgage data are leading indicators for the US consumer. If we see a further spike in CD rates toward 4.5%, expect more outflows from the S&P 500. The economic calendar for the next 72 hours is essentially a war room schedule. Every data point will be viewed through the lens of the Iran conflict and the energy shock. To conclude, we are at a critical inflection point. The market is transitioning from a growth and AI narrative to a geopolitics and energy narrative. The data is clear. S&P futures are down, the VIX is up, and oil is surging. The Buffett warning of $187 billion in cash is no longer a curiosity, it is a blueprint. When the most successful investor of our time moves to the sidelines, and the VIX hits 24.38, complacency is a dangerous strategy. The Trump-Iran conflict is the primary catalyst, but the underlying fragility of the European energy market and the uncertainty of the ECB are the structural weaknesses being exposed. Our short-term forecast, expect continued volatility. The Nasdaq is underperforming as the energy tax hits tech valuations. Bitcoin at $70,000 is a key psychological level. Watch if it can act as a haven or if it falls with the Nasdaq. Gold at 5,102 is the ultimate signal of a world in transition. The strategy for the next week is capital preservation. With CD rates at 4.30%, the opportunity cost of waiting for clarity is low. The oil rally has the potential to rewrite the 2026 macro story. If Brent sustains $87, the Fed path is dead, and stagflation becomes the base case. Stay direct, stay informed, and remember, in a market defined by uncertainty, the only hedge is discipline. This is the reality of the open. Watch the energy pits, watch the VIX, and watch the headlines from the Persian Gulf. The black box is flashing red. Good luck with the session.